And welcome to The Retirement Architect. My name is Cynthia Defazio, and I'm joined today by David Reyes. And David is founder and chief financial architect of Reyes Financial Architecture. David, it's always a pleasure. How are you today?
I'm well. How are you?
I am doing great too. Thank you so much. And I know that you have been so extremely busy, not only, of course, the television show, but the radio show as well. You have a lot going on right now.
Yeah.
So thank you for always finding the time to come in and do the show.
No, it's fun. It's fun. I enjoy it. You get more comfortable doing television. It's fun. I've done it before, but now we do it all the time, every week, and so it gets it's easier. You know, it's not as it's not as intimidating, right? You're first on television, like, oh my gosh, right?
Yeah.
Like I said, radio is easier. You get to hide behind the microphone, right?
Yeah.
But no, I love it. It's been great talking to people, and like I said, it's amazing to you feel more a part of the community. I always felt that way, but with television, for whatever reason, you feel more. You get more. There's more contact with people and just a bigger audience, and so it's been fun to do.
Yeah. Are people stopping you and asking you for advice when you're out running errands, like to the grocery store, dry cleaner?
Not yet. No.
Okay.
No.
Oh, well, that day will come. I am sure.
Yes, that's okay. Yeah, I'm okay. I'm a little, I don't need to be out there like that, but that's all right.
Yeah, definitely.
I'll take it, yeah.
Well, I know the viewers have been soaking up the information that you're providing, because the viewer questions each week, we've been able to just cover a couple of them each week, and we're going to do one show of all viewer questions eventually, but they become more complex. Like, they're very interesting. Like, they're really listening to everything that you're saying, and they're very much wanting valuable information on how to design their retirement plan, because so often we've talked in the past, David, that people will grab those statements out of the mailbox and they think that that's their retirement plan. If you ask them, do you have a plan for retirement? Yes, it's right here. Yeah. But that's not a retirement plan.
No.
It's a holistic approach that you take to build something that's going to work for someone throughout their whole retirement years.
Well, yeah, I mean, all I've ever done my whole life, 25 years, half my life, I'm 53, I'll be 54. Full disclosure, right? I'm in the disclosure business. So is that I always said an investment plan is not a retirement plan. Yeah. And more importantly, an investment plan is not a retirement income plan. Night and day.
Sure.
So we have to, I call it begin with the end in mind. The end in mind, I stole that from Stephen Covey's 7 Habits of Highly Effective People.
Yes.
Great book.
Great book.
You've never read it. I've read it.
I love that book. I love the story of the train.
Yep.
Oh my gosh.
Yep. So begin with the end in mind. The end in mind is, I want not the ultimate end. The end of our working years is income. Yeah. So everything we need to do is, my job is, number one, is to create the most amount of income with the least amount of risk and never run out of money. I always repeat it: the most amount of income, not the least amount of income. What do I get by with? What's the most amount of income with the least amount of risk and never run out of money? Yeah. If that's my job, then I just build the plans, reverse engineer to create safety and cash flow. And so that's just different than, here's how much stock and bonds I'm going to have in my portfolio. So it just takes a lot more, I think, expertise and experience, because I always say, you retire once, we retire every day. Yeah. And I have for many, many years. I probably will never retire from what I do because I love it so much. Sure. But the fact is that I've had the experience through, my clients' experiences to retire. Sure. And so I've been, thank God I've never had a client have to re-retire, right? Absolutely. And I've had clients come to me that have had to re-retire. I had a handful, 2 or 3 during the COVID crash, that lost half their money. He thought he was conservative. He owned half stock, half bonds. Half his stocks were all airlines and cruise lines. Oh no! He lost 65% of his portfolio and only owned 50% stock. Oh, and he was 7 years old.
Wow.
So it just depends, that's why you got to understand, what do you own? Yeah. Why do you own it? Yeah. So, managing risk, protecting capital, creating income is a lot different than what's the next, tech stock or Bitcoin. Sure. I mean, does it mean we can't own those? No. It just means that that's not going to be the core thesis of our retirement plan. Yeah. It doesn't mean we can't have those fun things, but they're fun. Yeah. They're not a have to, maybe it's a want to, or let's play. Yeah. A lot of times I'll just segregate. If a client has $1 million, I say, David, okay, here, can I manage 50,000 or 100,000? Yeah, go do whatever you want to do. As long as our investments and our retirement income plan is sound, then fine. You can lose all your money over here. It's not going to affect your wife and your kids and your legacy. Sure. And more importantly, you and your spouse, hopefully, as far as not running out of money. So, sure. It's just a different way to look at it. Begin with the end in mind. Absolutely. And that end is the beginning, hopefully, of having a lot of fun and less stress.
David, I know we've talked in the past a lot about inflation, if you will. So let me ask you, what are some investment strategies that you're using right now to help your clients manage inflation?
So inflation, as I've mentioned on prior shows, and I will say this for a long time now, because it's clients' portfolios are not positioned for inflation.
Okay.
And bonds are the biggest component of that. If you're half stock, half bonds, and your bonds are earning next to nothing, and as inflation rises, the value of those bonds go down because they're worth less cash flow, right? The income's not worth as much money, and you have healthcare costs and all those kind of things, and long-term care costs. Is that we need to proactively deal with, and we've implemented these types of things for different reasons on top of inflation to deal with cash flow. But you know, one of the easy ones to do is owning a dividend-paying stock. So we have a portfolio called an enhanced dividend strategy. So I would say if we're going to own stocks, I want to get paid. I want income.
Sure. And
we're trying to solve for income. So our enhanced dividend portfolio is paid historically around a 5% distribution rate, meaning if you had $1 million in there, you're getting 5%, $50,000 a year of cash flow.
Okay.
Okay. Nothing's guaranteed. It's not guaranteed. That's just what it's produced historically.
Right.
As of today, I think 2020, our yield was 5.5. So very good, considering the dividend yield on the S&P 500, meaning what the average dividend is 1.5%. Ours was 5.5. So that's really good.
That is.
And we only invest in that portfolio in dividend growth stock. So for instance, Home Depot's in there. And I'm being a little granular right here, but you're asking a very important question, is that like Home Depot, they've increased their dividend 25% in the last 5 years.
Okay.
That's inflation protection. That's real inflation protection. Our income is actually going up, meaning that they're increasing their dividend, which increases the cash flow. So on typical, we're looking at about a 5 to 6% increase in the dividend in the portfolio per year on average. So meaning we want a 5 or 6% increase in the actual cash flow.
Okay.
It's hard to do that. Bonds are not going to do that for us.
Right.
So a good dividend portfolio that focuses on cash flow is one. So again, if I'm going to own stock, I want to get paid. I'm in retirement now. I want cash flow, and I don't have to sell my Apple stock or my Home Depot stock to create the income. That's not income. Number two would be probably annuities. I like to use principal protected, inflation protected annuities. There's some good products out there. As a firm, we're a fiduciary, so we use every asset class available. So we work for our clients independently. So I use real estate, I use stocks, we use annuities, we use the A word, right? Oh, annuities are bad. No, there's bad ones, there's good ones.
Right.
Most of the annuities we use are 0 fee to 1%, maybe 1.1% in the fee. That's where they get attacked a lot. But what if we had a product? I like to say, I don't care what it's called, I care what it does. I don't care if it's a dividend stock, an annuity, real estate, what does it do? So what if we had a strategy or a product that gave us lifetime guaranteed income for both you and your spouse, but we also got increasing income with inflation? So if we can have, in our equities, we can own some dividend stocks that pay us a good income and increasing income. We can own an annuity, guaranteed lifetime income annuity that has inflation protection. A third component that we use to deal with inflation head on is real estate. As I mentioned earlier, the last 20 years, the best investment, if you own mutual funds or ETFs or whatever the heck you own, was real estate investments, REITs, real estate investment trusts. Number one. Number two was gold. Most of our clients own both. Most portfolios don't own any of that. So if we can add real estate, dividend stocks, lifetime income annuities with inflation protection. Now all of a sudden what we've done is created cash flow, diversification, increasing income. So that's a totally different picture, and to get there takes a lot of planning. I've said a lot there. That's a whole, you know.
It's incredible when you think about it.
Yeah, but to do the things, that you need to do properly, you need to break it apart that way and diversify not only by different kind of instruments, but by strategies. So, you know, diversification typically is I own, 50 stocks, I own 100 stocks, I own 20 mutual funds. Well, but what if you don't own any gold? What if you don't own any real estate? What if you don't own any annuities? I'm going to be a lot more diversified than you are, because I have different asset classes, so there's a lot of misinformation about that, and so I'm trying to solve for lots of different things at one time. And so the fact is that it just takes a lot of time, energy, expertise, and experience, I think, to do it. I mean, I know it does.
I think the key word you said is experience.
Yes, it does.
And you definitely have that, the experience and the passion. This is the perfect time for us to open up the phone lines to the viewers at home. Would you agree?
Yes.
Okay. To the viewers at home, the phone number to call on your screen is 866-739-3775. We know you have a lot of questions about how to retire with confidence and how to retire comfortably. David has the answers for you. You've worked your entire life to get to your retirement, and you should be able to enjoy the retirement of your dreams. If you need a second opinion, actually, if you have a plan in place, let David take a look to make sure it's the right plan for you. But again, this opportunity is available to the first 10 callers only. All you have to do is pick up the phone and call 866-739-3775. We'll be right back with so much more after this very short commercial break.
How confident are you in your current financial plan? Do you know with certainty how the recent market volatility will affect your future hopes and dreams? How much are you paying in taxes? And how much are you losing to unnecessary high fees? You didn't work to save this money so that you could spend your time worried in retirement. Now is the time to take charge of your finances so you can feel confident about your future. Call in during the next 30 minutes of today's show only to set up an absolutely complimentary, no obligation, full-blown financial review that will result in your own customized written plan. This is a $999 value that we're giving away complimentary to the first 10 people who respond. We'll start with a full-blown analysis of what you already have, by running a report to untangle how much you are currently paying in fees, how you're allocated for risk, and what it's costing to work with your current advisor. Next, we'll identify your goals. Where do you see yourself in the next 5 years? Where do you want to go, and who do you hope to go there with? Is your current financial plan set up to get you there without mishap? Let's design a roadmap to create a financial plan you can follow with confidence. Get the piece that so many people are missing from their retirement. Find out how having a written plan can make a difference to your retirement dreams. Call now to schedule your complimentary, no obligation, full-blown financial review today.
And welcome back to The Retirement Architect. My name is Cynthia Defazio. I'm joined today by David Reyes, and David is the founder and the chief financial architect of Reyes Financial Architecture. David, a great show that we're having today. Obviously, again, talking about the importance of planning for retirement, being prepared for inflation. And I love when we go to the commercial break and I can see the phones line lighting up. I know the way you're looking, you can't see them, but from my direction, I see them.
Oh, good.
It's just exciting because I know people are really wanting to have that complimentary consultation with you. So they can't wait to come in and meet you and the whole office. So you have actually 7 rules to live by, and I love this because let's talk about them. The first one is avoid large losses. Let's talk a little bit about that.
Yeah, sounds kind of basic, doesn't it? Yeah, but it's not. I mean, I can tell you, avoid large losses because it's pretty simple. The more you lose, the more you have to gain to get back to even. I mean, that's kind of, and getting back to even is not an investment strategy. But believe it or not, a lot of clients are, oh my gosh, I'm underwater. How do I get back to even? Well, if we're getting back to even all the time, we're not making money.
Yeah.
And so, if you lose, I mean, during the COVID crash, I call it, from February 18th to March 23rd, the market lost 35% in 30 days.
Wow.
Think about that, from 35% in 30 days.
30 days.
Unless you're prepared for that today, like we were before, right, then you're done. Because you have to react to it. It's too fast to react to that. And the markets going forward are going to be that way. There's no question. There's much more volatility in the markets, both up and down. But the fact is that avoiding large losses, and you lose 35% like the market did in March in 30 days, it takes 55% to get back to even. Now, through the grace of God and $4 trillion worth of stimulus, we got back to even in 5 months. Not 5 years. Like in 2008, it took to 2013 to get back to even. 5 years. We got back to even in 5 months. Probably will never happen again. There's only so many bullets in the chamber. Eventually, we're not going to be able to fix the problem, right? And that's a whole other story that we could do a whole show on. But the fact is that avoiding large losses, because it's about cash flow. It's about, so if I lose 35% of my assets, I lost 35% of my assets, which reduces the amount of cash flow I can take from those assets. So avoiding large losses is the number one. We try to stay, basically, we call it the 5 to 10% rule. We want to be in that range of total assets. So if the market's down 35 and we're down 10, 12, in that range, we want to be in that, and we've done a pretty good job of that. The only way to do that is you have to focus on managing risk and also own asset classes that don't have correlation to the stock market, right? We use principal guaranteed products, we use annuities, we use real estate, hard asset real estate, other things that do not respond. One of the best strategies we've had for the last dozen, well, not dozen years, but last half dozen years, has been invested in real estate, where our clients are invested in what's called necessity-based real estate, where they own their owners in shopping centers that have Walgreens, CVS, Kroger's, those types of grocery discount that had no, basically they had no lack of payment during COVID. They paid 6% distribution rates. They had, again, it's an asset class that's safe, that's not tied to the stock market, that pays us income. And so building portfolios like this to absorb stock market losses like that, you'll hear me talk about, if we're looking at the stock market every day for our retirement, then we're not properly diversified. So we want to avoid large losses, and have to be in a position to understand managing risk and other asset classes that will reduce risk and also create cash flow.
Okay, all right, thank you so much. Also, minimize fees.
Minimize fees, big one. So for every client that comes to see us, prospective client, we do a fee audit. Okay. So the most expensive investments, people talk about annuities sometimes. If you have annuities, we'll look at the fees that you pay. But one of the most egregious is mutual funds. People that just own regular mutual funds. The average cost of a mutual fund, according to Barron's, is about 3.14%. I can tell you, doing audits every day for clients, I would say the average client that sees me is around 2.5% of total fees. That's external fees, internal fees, trading costs. There's all these terms called cash drag. We do a full analysis. Just know that if you own mutual funds, that you're probably paying too much in fees. We don't use mutual funds as an investment vehicle because they're expensive. As an example, if you owned our dividend portfolio and we own Apple stock as an example, or Home Depot, it doesn't cost any money to hold that stock.
Okay.
It's zero cost. So right now, trading costs are zero. So if we bought and sold Apple and bought Home Depot, there's no cost.
Okay.
If you own those same stocks in a mutual fund, it could cost you 1-2%. It's the same investments.
Okay.
So part of what my job as a fiduciary is to reduce your costs as much as I can.
Okay.
We don't want to pay for things that benefit us.
Okay.
Right? That we're getting value from. So mutual funds are like the dinosaur of our investment industry now. Now you want to own individual stocks, what's called exchange traded funds, which are much more cost efficient, much more tax efficient, much more liquid. There's really not a really big case to own a mutual fund. So fees, reducing fees is significant. So in most cases, we're cutting clients' fees in half at a minimum. So we want to do that. So if we want to avoid large losses, we want to reduce costs, things like that.
Okay, okay. One thing you just mentioned in that conversation piece was fiduciary. So in case someone is in the viewing audience today that maybe is catching that buzzword, let's talk about why that's so important to have that standard actually.
Yeah, I hate all these words, right? It's part of, I remember my grandfather, I'll talk about him a lot. He used to say, you know, he's a smart guy. He was an engineer by trade, ended up working for Sears. He got a little burned out, and he was an entrepreneur, had you know, went challenges, owning his own business, and kind of gave in. And, okay, I'm just going to work for the man.
Yeah.
And I remember he said, a doctor's a glorified plumber, you know, and no offense, but an advisor's no different. A lot of it is just the vernacular, the verbiage, the you know, like attorneys have their own language, and the financial, I call it financialese. So a fiduciary, what a fun word. All that means is that it's an important word. It means that as a fiduciary, we have a legal standard of care to put your interests ahead of our own in the firm. Big important difference. So a broker, a traditional broker, is not a fiduciary. They only have what's called a best interest standard. Well, it's changing. But the fact is that you want to work with a fiduciary because at least you know that they have a legal standard of care. And so traditional advisor and brokers are going to have a suitability standard. So as long as it's suitable, it could be a really bad product relative to how it's performed. But if it's suitable for you, like an annuity,
sure,
you can have an annuity. It could be suitable for you because you don't want stock market risk. But what if it's a really bad product?
Yeah.
Now that broker that's not a fiduciary isn't going to have an issue. As a fiduciary, I have a higher standard of care. I put your best interest at heart. So maybe an annuity is appropriate, but also what's the best annuity contract?
Sure.
Right? So it's a different standard of care. So if you're going to be looking at investing the time, energy, and your money with an advisor, make sure they are a fiduciary and they do work for you. That's very important.
Absolutely. Well, thank you so much. Just in case someone had questions about that, I think it's so important that we talk about that. Let's talk about significantly reducing volatility.
Yes. We should have an acronym around that, right?
Yes.
Talk about financialese, but it goes back to avoiding large losses.
Okay.
Volatility. If we only need, and I know this from experience, if we only need a 5 or 6% rate of return compounded every year to have the kind of lifestyle we need, why do we want to have our portfolio exposed to 20, 30, 40% losses? It doesn't make any sense.
Sure.
So we want to avoid large losses. We want to reduce the fees because those are a drag on return. So we want to avoid expensive investments. And so that volatility we want to avoid. And we're going to do that by investing in different strategies above and beyond stocks and bonds. And so those are all, some of the principles. I think we're on number 4. I don't know if we'll probably have time for all of them. But
we're going to take a commercial break first.
See, I knew
it. Great time for that. To the viewers at home, the phone number on your screen is 866-739-3775. We know you probably have a lot of questions about how to retire with confidence, how to retire comfortably, Remember, you've worked your whole life to get to this point. You deserve to retire with confidence and having peace of mind at night to sleep. The number is 866-739-3775. What David is offering you today is a complimentary consultation to the first 10 callers only. All you have to do is pick up the phone and call 866-739-3775. When we come back, we're going to follow up on those points that we're going to talk to David about, so don't go away. We have so much more when we come back.
As a good saver, you've been putting away money during your working years. Studies find that the biggest fear of retirees is running out of money. Market volatility isn't just the downward movement of stock prices, it's the size and frequency of change. The more dramatic the ups and downs, the higher the volatility. This can put savers who are newly retired or a few years away from being retired at greater risk. Today's generation of retirees is not receiving traditional pensions as our parents or grandparents did. Instead, we have retirement accounts such as 401ks or 403bs. These accounts typically expose your money to market risk. The last thing you want right before retirement is to lose a portion of the money you need for income. But how do you turn these accounts into a retirement income? Is it safe to keep all your retirement money sitting in the stock market? The last thing you want is to lose a portion of the money you need for income due to market loss. By working with a financial professional, you can learn how to turn a portion of your savings into an income stream for life and income for the life of your spouse if you're married. We all have moments in our lives when we wish we had taken action sooner. Don't let procrastination reign on your retirement parade. Act now before it's too late. Please call our office to set up your no-cost, no-obligation retirement income review today.
And welcome back to The Retirement Architect. My name is Cynthia Defazio, and I'm joined today by David Reyes. And David is founder and chief financial architect of Reyes Financial Architecture. David, again, the phone lines were going crazy. So let me ask you, who benefits the most? Who is your ideal client, if you will, from calling in the number today?
Yeah, that's a good question. So our average age of our client, just use age as a benchmark, right?
Okay.
We do that, is probably late 60s, 67. It's acquired assets. Our minimum as a firm is $500,000.
Okay.
We're a small firm, boutique firm. We do a lot of work for clients, so I wish I could help everybody. I always say, if somebody calls me, we'll give them advice.
Sure.
I'm a radio show for 15 years. Everybody who calls, I will talk to and help them if I can, even if I can't take them on as a client.
Sure.
But at a minimum, so our minimum is $500,000. And the reason for that, again, is that what we're best at doing is protecting and growing and creating cash flow.
Yeah.
And dealing with, beneficiaries and estate planning, things like that. So kind of you and, whoever's going to be left, or if you care or not care, right? Some people don't. They want to bounce their last check, or, they want to give as much money away as possible to their kids or to beneficiaries. So it's somebody who's accumulated a decent amount of money, who's concerned about outliving their assets, who's concerned about taxes, their estate, and that is either about to retire or is in retirement.
Okay.
That's our ideal typical client.
Okay, so $500,000
Yes.
typically is your threshold. All right, perfect. Let's go back to the 7 rules to live by. Let's talk about the earn a reasonable return rate.
Earn a reasonable rate of return. So what is reasonable? In my world, reasonable is probably 5 to 6 to 7% in that range, right? So I will tell you, when we're doing income planning, 5% is our bogey. So if you were my client, you have $1 million, we're going to produce $50,000 a year of income and have you have that income for the rest of your life and your spouse's life. That's just what we do, and that number is pretty much what we do. If according to Morningstar, who's one of the experts in the industry, because of low bond interest rates and low bond rates, is 2.8% is a distribution rate. So to me, you have to do some more sophisticated planning to get to a 5% number. That's a really good number. Okay. So if we got a 5%, I'm talking consistent, not 20%, not average. I'm talking 5% because we're not getting back to even all the time. Right? We lose 35, we need 55 to get back to even, right?
Yes.
And so just like what happened with COVID. So the fact is that if we earn a 5, 6, 7% rate of return over time, and doing this for a long time, that's the number, you're fine. So we want to be more goals-based and needs-based. Not, wants fine, that's okay, but let's do that with a separate part of our portfolio. Okay. Right? If we have $1 million and we can, and $800,000 enough for income, and we can invest $200,000 more aggressively, then fine. Yeah. But let's take care of you and your spouse first, and go that way. So we want to make sure that we avoid large losses, we reduce fees as much as possible, we create income, and those types of things that are important that not everybody is focused on.
Okay. Manage taxation. That's a big one.
That's right.
And I know you're passionate about this.
Yes, yes. So taxes are they're a cost. So we're going to look at, not only we're looking at the cost you're paying in fees, but taxes are a fee.
Yeah.
So we want to mitigate the cost of investments that we own. We don't like mutual funds in particular, like we talked about earlier, because they are expensive. And they're just not something we're getting value from. There's other investments that we can go into that hold the same assets that are much less expensive. Taxes are the same way. How do we mitigate taxes? It's tougher and tougher. The tax code's gotten more difficult to really, there's some things we can do where we can reposition assets, retirement assets, to make them tax-free distributions. I'm more excited going forward because I think the Biden administration wants to raise taxes. Whether you think that's a good idea or a bad idea, I mean, I'm not really thrilled about that, but the fact is that so there's things that we can do, especially for after-tax investments, that we'll be more specific in another show about how we can reduce the taxation or defer the taxation or eliminate the taxation on certain types of after-tax investments.
Okay.
And so we're always looking at, real estate's a good one. So if we own a real estate investment and we get to write off the depreciation, with some investments we're only paying interest on half the income.
Yeah.
So let's say I'm getting 6% income from my real estate investment, but I'm only paying interest as if it's 3%. So those are the things we're gonna micromanage all those things and make sure, because I'm focused on net income.
Yeah.
It's not how much we make, it's how much do we keep.
Exactly.
Right? So that's cost, and keep is also losses. So I want to avoid large losses. I want to reduce my fees. I want to reduce my taxes. I have a high bar. I want
That's a good
it
bar
all.
to have. No,
right?
a high bar is good. And then, of course, generate certain income, which we can talk about in another show, but also the written retirement income plan. We only have about a minute and a half left, David. So let's talk about the importance of the written retirement income plan.
Everybody, all of our clients have a written retirement income plan, 100%. I will tell you, I can count on one hand the amount of clients that have come to me with a written plan. Right. I mean, so we write down our to-dos that day, that we need to do. Very few clients have a written retirement income plan, and so that is critical. Part of our 7 habits, our 7 rules, whatever you want to call them. If you don't have a retirement income plan, I'll do one for you for free. That's part of our process, part of our second opinion review. We will do a written plan. If you have $500,000 or more, you go through our process. I will do a plan for you. I won't charge you to do it. And at least you'll have someone from, and you don't have to hire us to do that. We'll do that for you as part of our second opinion. So that's how serious and committed I am to doing written plans, because it is super important to have. And if you don't have one, get one. If your advisor doesn't have one for you, then get another advisor.
Sure, because it's so important. I agree, exactly. You have to have it, and have it be adjustable too. It's a living, breathing organism, if you will, because life changes.
Well, in writing, and that's why we want stuff in writing. I'll put it in writing, right? So if it's not in writing, then they may not be that confident about the plan.
Exactly.
So we want to be confident.
Well, David, thank you for another amazing show this week. We only have about 20 seconds left, but I can't wait to see you back again next week. We have so much more to cover. To the viewers at home, thank you for spending time with us again this week. That number to call is 866-739-3775. Again, don't forget, 866-739-3775. Be safe, be happy, be blessed, and we'll see you back here next week.